What's going on, Dividend Chasers? It's the Dividend Bloodhound here with another investing episode. In this episode we're going to talk about my trading 212 account and the rebalancing and consolidation that's going to go on in my portfolio as of the next couple of weeks. I'm going to swap from bringing monthly updates to you to weekly updates, so I can add in any more recent changes, any dividends that I receive. I'm going to hopefully bring them to you quicker rather than doing one review update that's going to be a really long video. I'm going to bring shorter videos so you can see what's going on a little bit quicker, and then I don't have to do a dividend video after that as well. So I'm going to try and combine both videos but into shorter, sharper, less information in each one. Fortunately, that means that this video is slightly longer, but while I explain my changing strategy and what's going to go on, but in the future there will be shorter, sharper videos for you all to enjoy, hopefully. Now, as you may have seen in my recent updates over the last few months, my portfolio has taken shape. It's moved over from UK stocks. I've got a few US stocks in there, Dividend Kings that are in there, and then I've got European stocks in there at the moment. And my strategy has got a little bit wayward, to say the least. What I've done is through no fault of my own, I've spotted bargains all over the place due to the pandemic that we've been experiencing, and I've taken advantage of this by buying into companies as and when I can. What this has done has made me unbalance my portfolio and take me away from what my actual strategy was with trading 212 going forward. Now, my dividend portfolio and my dividend income and dividend growth portfolio is over with Freetrade, and what I'm trying to do with trading 212 is make this a growth portfolio, so concentrating solely on just growth stocks. And I've bought into value companies that I know are going to recover over the long term. I think that's going to give me some price appreciation, but then after that they're going to get their dividends back, and then their price is going to taper out and they're not going to grow as much as I would perhaps want. This portfolio in the future is going to be solely for growth purposes only. So I'm going to withdraw my money from the European markets, the likes of BMW probably and Bayer, that side of things. I'm going to pull that money back and I'm going to solely focus on growth companies, mainly in the UK and the US, because that's where the high potential companies are. I'm not going to withdraw from all my positions because I really do believe in the price growth of Airbus and where Airbus is going, and I'm going to have to really look long and hard at the positions that I've got. But going forward, I know that I want to concentrate solely on growth stocks in this portfolio. So Altria, the dividend king that it is, when that recovers and I'm not making a loss on it anymore, that's going to get sold, and then it'll be replaced with a growth stock that's hopefully going to appreciate really well in the longer term. And I'm going to be using Trading 212's Pi app, or Pi part of the application, to do this as well, to bring in the auto invest option that has already gone out. I've seen a few other YouTubers bring videos to the fore now on this, and I'm going to take my own element with this going forward and really try and grow my money in a growth way rather than just dividend income. Dividend income will be my main, and passive income will be my main account, and that's where the majority of my money will go. But Trading 212 has got some really good options to act on. Like, I've bought shares in the Tattooed Chef merger, the forum merger that's going on, and I've also got involved with hyliion as well, which have been quite lucrative returns. That is quite risky, but that's what I want this portfolio to be about, a little bit high risk, high reward, but also companies that have got really, really good growth potential, the likes of Amazon, Tesla, AMD, Apple, that side of things. That's where I want this portfolio to be focused, and that's what I'm going to do going forward in my change in strategy. We'll get into the app in a minute so you can actually have a look at what's going on. I haven't actually made any major changes yet, but I will be showing you exactly what I'm going to potentially get rid of and where I'm going to reinvest my money in the future to coincide with the change in strategy that I've literally just set out for you guys. So yeah, going forward, lots of big news in this video really. Weekly updates for both Trading 212 and Freetrade. That will be it really. I'm not going to do dividend videos, not going to do anything like that. They will all come in those weekly videos. and then a change in strategy from trading 212 where it will be growth centric. That is what I'm targeting. I want my money to appreciate in a growth way. I'm not going to be so fussed about dividends in this portfolio. It's all going to be about the return and the percentage return that I can garner on these stocks. And the dividend portfolio and all the dividends will come from, or most of them, the really high yielding companies, safe companies that I'm going for, the dividend kings, the dividend aristocrats. They will all be held within Freetrade, and that will always be the bigger portfolio. And obviously because it holds my ISA, that's where I want my tax shelter to be. So we'll get into the app any second now. Just quickly, all I want to say first is thank you very much for taking the time to view this video. If it does bring you some value, please hit that like button in the corner. And if you're brand new here, I'm the Dividend Bloodhound. It'd be absolutely fantastic if you could hit that subscribe button and even ring that notification bell as well. That'd be fantastic. So you get notified of brand new content that I release in the future. That being said, let's get in there, roll the intro and get into the app. Catch you in there. What's going on again, guys? Welcome into the app. So here we are at the moment. Then we have a portfolio value of £1,079, currently £10 down or 0.9%. I have got a little cash reserve built up in the portfolio at the moment of £150 of free money, which I'll decide to use as and when. Let's actually have a look at what I'm holding at the moment. So currently I have Airbus at £119 for 2.03 shares, currently £6 or 6% up. Came back down from its recent spike where it was heading off to the moon at one stage and then came crashing back down as reality seemed to hit. Do believe in this company long term. It's had to make some job cuts recently, which is obviously a shame for those people, but they're doing what is absolutely right for this company to survive the health crisis, and that is going to be something that is prevalent for a long time with all these companies, I would say, and Airbus is going to be one that stays. Hyliion is a dividend payer, but it's over from Germany. 0.4 shares of this one for £64. I'm currently £8.49 up or 15%. Recovered halfway towards where it was pre-crisis. Still some money to be made in this one. However, it doesn't quite fit the new strategy, so I may be selling out of this one. It is on the list to sell. Altria again, I'm £16.83 down on it at the moment, or 11%, currently worth £126. This is one that's definitely on the target list to go, unfortunately, because it doesn't fit the new strategy, but I'm not willing to make an 11% loss on it, so I will be keeping it until I can make no loss on it and a little gain and then transfer it off that way. Next up we have Babcock and BAE Systems. BAE Systems is a company I've wanted to own for a long time, so they will probably survive. They've cut their dividends at the moment, or suspended them, should I say, with the intention of returning them. Currently worth £38, £2.80 down or 6.7%. Babcock here, also another company that I did want to own, so these may survive, especially as they're UK based. £31 at the moment for 10 shares, £8 down or 20%. Suffered quite a big decline at the moment, and I think they're at the lowest they've ever been, as you can see here, based on some poor numbers in the fundamentals really, and the health crisis is of course not helping at all. Next up is Bayer, another German company, another German pharmaceutical company, currently up £6 or 11% on this one. Good dividend payer, no problems with this company at all, it just doesn't quite fit my strategy, and the German withholding tax is 20%, so that is something that I want to try and reduce in the future. Same sort of problem with BMW here, so it's worth £54.98 now, and £4.50 up or 8.9%. But suffering from the same problem. I want to cash this in and reduce it and get it into growth. British Land Company really letting the side down at the moment. 11 shares for £42, £15 down or £26. They've suspended their dividends due to the health crisis. Although it says the dividend yield's still there, they are not. They are suspended until further notice. But now the economy is sort of opening back up. People are allowed to go and get haircuts, would you believe it? And the pubs are open. They should be on the recovery soon, and that should be reflected in the share price. And the share price and dividends should return. But again, when they do, I will probably chop these in for a growth stock. Continental are got the same issue. Worth £61.98 at the moment, £7 up 13%. Got some growth they could potentially take place, but they've had to write off such a lot of their intellectual property and devalue it because it's been taken off elsewhere, that their current share price is starting to look fairer and fairer. This is more like where they should be, so there's still a little bit of growth in it there, but yeah, again, I'm looking to move my money into growth, so this is where the change in strategy is going to come. Mercedes-Benz, absolutely great company. I used to own a Mercedes-Benz, absolutely love the car company itself. Still got some real potential growth to get back to where they were pre-crisis. I might keep hold of them until they do that, but then I am already 24% up on them, or £12. So again, I could cut, well, it's not even a losses, I could take a quite tidy profit right there. And the dividend yield is quite low, so I'd be happy to take the gains that I have made. Dutch Lufthansa, I'm going to have to accept, is an airline, and it's going to be down for quite a considerable time. I bought in at the wrong point. But they are due to, the countries are reopening back up again, so that again hopefully will reflect in the share price, and I can get out without making a loss, or at least average down. No dividends to be had. I've just got to wait for this one not to make a loss. They shouldn't go bust by the look of it. They have got state aid coming, so I think it's just a case of the waiting game with this one. Next is Forum merger. This is the tattooed chef merger that I got in on. I made a video about this one as well, which I can certainly link in the description below. Currently 13% up on this one, or £1.63. Only owned it a little while, and they haven't gone IPO yet, but it's starting to gather some momentum, as you can see, as investors come on board and realise there's some money to be made. Next is Iron Mountain, another dividend payer that's supposed to be that doesn't fit my new strategy. 3 shares at £62.77. Currently £10 down, or 14%. Again, I'm going to have to just wait this one out, maybe average it down and then get it out. There is a 10% yield. They are still holding that, so I am going to get some decent dividends as long as they don't cut them along the way. But again, got to swap this one out as well. This is by far my worst investment on this app and across both of my portfolios. That is Occidental Petroleum, 3.15 shares, currently worth £44, down 45.78, or 50.53%. No dividend now, really, basically 0.22%. I really don't know what I'm going to do with this one. I either take the £45 loss, try and play the patient game and get it to spike a little bit, so I take up a little bit less of a loss going forward. But I've basically resigned myself to the fact that I'm going to lose money on this one, but I do want to get rid of it from the portfolio so I can repurpose the money into gaining some money back, because I don't think Occidental Petroleum is going anywhere or doing anything anytime soon at all. My bad with that one. Royal Caribbean is next. They are at 2.35 shares, currently worth £93. I've made £24.36 on this one. Currently 35.43% up. Would you believe it that it went up all the way to 75 at one stage, and I basically made 100% return. I could have cashed out then. With my new strategy, I wish that I potentially had, but at the same time, I know that it's going to go back to that sort of a level again pretty quickly. It didn't take long to do that. And then if it was to go back up here this way, as people start going on holiday more, and I was looking on cruise channels the other day, people are actually booking for 2021, 2022 and beyond. So there is some revenue for these companies, and I think going forward they will actually survive and again begin to prosper, and that should be reflected in the share price. So this one will be worth keeping as a grower, I think, and this one will survive. Siemens is the third last position in this portfolio, and it's done its growing really. I bought it at a low rate just down here, as you can see where the dotted line is, and I've made £26 on it, or £29.43. It's not got much room left to grow back to where it was beforehand, so this is one that I'm going to take the profit on. It is a dividend payer at 3.68, quite a safe company as well, and if it were available on Freetrade I would probably rebuy it on there, but at the moment I'm going to take my profit and reinvest the money into growth stocks. Fantastic company, but I've made my money on it and I'm going to move the money on elsewhere. Tortoise acquisition then, this is one of my success stories, with a little bit of thanks to JMac Investing, who originally opened my eyes to this one. I then jumped in, did a little bit of my own research and had a look myself, decided it's a company that I really want to be on board with, and there we have it. I've jumped in with 2 shares, made £16.20 or 60% up at the moment, which is absolutely brilliant. Tortoise acquisition at the moment, or SHLL, but it is hyliion going forward, and I've got a lot of faith in this company over the long term, so I don't think I'll be selling out of this company anytime soon, especially not before IPO, because I think the potential for it to go massive is almost, I don't want to say certain, but I really do like where this company is going. If you don't believe me, go and have a look at the research and research what they actually do. It's absolutely fantastic, and a really good stopgap between the polluting trucks that we've got at the moment and then the electric trucks that Tesla or Nikola are going to provide in the future. And I think even $26 a share is quite cheap for what they will eventually be. And last but not least is Virgin Galactic. Now they're 36% down at the moment, or £14.82. Richard Branson had to ship a load of shares in this one so we could keep Virgin Atlantic afloat. But there's the potential for space travel is always there and always growing, I think, and it won't be long until people get back on board with this one. It's got a couple of FAA accolades coming up over the next couple of weeks, which are key to it towards its future. It also won a NASA contract not so long back as well, which also caused a spike in the share price. And I believe that over the longer term, this is one to watch. And this one, despite the loss that it's making, will actually be something that I keep long term, I think, and it will actually survive my rebalance and my cull and my consolidation that's going to go on in this portfolio. So at the moment, nothing has majorly changed yet, but there is big change afoot for this portfolio. And just to give you a little taster of what that's going to look like, here is the first pie that I created. It's called Fang Plus, and it's going to have in it Microsoft, Amazon, Apple, Tesla, Facebook, Alphabet, Salesforce, Nvidia, Adobe and Netflix. And the potential return on this on these companies is absolutely insane. It's not quite finished yet, and I'm going to bring a brand new video on that when I actually fund it as well. There's a little taster about where I'm heading in terms of growth. That's what the target is, and that's what the plan is for the future. I'll bring you another video soon with that, and with this I will see you back in the real world. Catch you in a second. Welcome back to the real world, guys. Hope you enjoyed the video there. That is my brand new strategy for trading 212. Probably not unheard of. People have heard of growth investing and dividend investing, and there's arguments afoot out there over which is actually better for you in terms of your financial freedom. The way I see it is, like, I want to do both. I want to have my income that will eventually replace my active income with passive income from dividend investing. But then I want to actually grow some money at an exponential rate much quicker than you normally would with dividend investing. And yes, you can reinvest your dividend, the dividends that you get, but still that is quite a slow process. And I don't get me wrong, I absolutely enjoy it, I really do, but also I know that I want to grow my money a little bit quicker and see the returns in it a little bit quicker. And by the likes of investing in Amazon, Apple, Facebook, that side of things, as you saw in the trading 212 pies there, that is a quick fire way to get a good return on my money as well, especially investing in like the speculative stocks there and the SPACs that are just on the cusp of going places such as hyliion, as you've literally just seen my return on. That's what I want this portfolio to be about, and that is high risk, high reward. But that's what I'm going for here. The stable side of things will be held with trading, not with trading 212, that's this one. They'll be held with Freetrade, of course. The way I see dividend investing and growth investing is that through dividends, it's like cutting down a tree. A dividend paying stock such as Coca-Cola will pay you that dividend forevermore, and that's like having a fruit tree in your garden. It will give you every couple of months or so, it comes around, every 3 months or so it comes around and drops a little bit of money in your pocket or bears fruit. Now, the tree itself is probably worth more money if you cut it down and you sell it for lumber, let's say, just for argument's sake. You probably get more money up front if you do that. So if you've got a company such as, let's just take Tesla for example, and you bought in for £400 a share and now it's worth £1,000, just for argument's sake, it's £1,000 a share. Now, yeah, great, you've made £600 there, that's absolutely awesome. But to get at that money, you've got to then sell that stock. And that crystallises your profit, and it will always ever be that. And then to get back in again, or to raise money again, you've got to find another company to do that. I intend on keeping my money in the likes of Amazon and Tesla for a very long time. So hopefully that £300 that I invest, or however much it is, does become £4,000 over 20 years or whatever. I don't want to touch it, but I understand that if I do, I will crystallise profit. Whereas with dividend stocks and dividend paying stocks, the return on cost and the return on investment will only get better over time, because the share price should slowly grow, which it does usually with the best value companies, and then over the slightly longer term, so does the dividend. The dividend gets bumped up a few percent each year, and then a few more percent, and then a few more percent, but the cost that you got in at remains completely fixed. So owning a dividend paying stock for 30 years, your return on that will be absolutely insane. And that's where the argument is, and I'm not going to go into it any more than that, because you could argue until the cows come home. But all I'm saying is my strategy is to have both free trade on this side, dividend paying, trading 212 on this side, which is going to be purely growth, and that is going to be my strategy going forward. Really hope you enjoyed this video, guys. Thank you for sticking around to the end and watching all the way through. It takes some endurance to do so. I know this has been a longer video, so thank you very much for doing that. If you haven't already, please hit that like button in the corner there. That would be absolutely fantastic. It helps the YouTube algorithm, lets YouTube know that you guys like what I'm doing, and really gets this message out to more people. And that's what I want to do, help as many people as I possibly can, and inspire as many people to invest as I possibly can, because it really isn't that hard, honestly. If I can do it, you can do it. And lastly, I would just like to say, if you're new here and you still haven't subscribed, what are you doing? Please do so right now. That would be absolutely fantastic, and I would appreciate it massively. Little red box in the corner there, and even tick that notification bell as well. That would be fantastic, so you get notified every time I produce brand new content just like this. That would be absolutely fantastic. This video has been a pleasure to make and a pleasure to bring to you guys, and I hope that I'll get to see you in another one of my episodes in the near future. That being said, I will catch you in my next episode and see you again soon. Bye bye.